Yo, what up, everybody? Sorry for the delay. Been multitasking all morning long. Yo, it has been a wild ride. We saw the Dow futures go down almost 1,000 points. We saw oil hit 119, 120 a barrel to start the week in the futures market, and then we opened up below 100. We're now $97 a barrel. We did say on the show the weekend before the war kicked off that crude oil was likely going to be the biggest conversation point, and it has. We also have some pretty interesting things happening politically. I think what you're going to see is you're going to see both Israel and the United States talk about off-ramps to the war. What's the ultimate end-game exit strategy? Because there are financial ramifications. We do have a little thing called the midterms coming up. So there will be all sorts of political pressures on how they are going to resolve that with a good narrative prior to the midterms. We're also seeing some stuff on CNBC where the president is speaking and did make some shots, take some shots across the bow against Cuba, which was kind of wildly unexpected. What up, Corey? How you doing out there? If you have not tuned into the show, this is the Higher Standard Live. We give you the media data-driven variant of the show. This is much more macros, a lot more information. We try to truncate everything you get from CNBC in a solid hour time, including the behavioral economics piece, which is going to include a review over social media and some things like AI on the show that we did implement and use. To that end, we have made some improvements. Last week, highlighted some weaknesses, not only in Fed liquidity, because we noticed how much money the Fed was dumping into the system, and yet we had some remnants of the contagion period there. Those have been rectified. When we get to the Fed liquidity portion, I will show you the corrections. We've also edited and changed the Synthetic Volatility Index to be more reflective of economic volatility in bad times. I did not like how the model last week showed us that it wasn't as scary of a market from a risk perspective as I thought it felt like it should be, and especially when the VIX was rising. So one of the things I did not expect when we built these models was to get the opportunity to test them in a very, very positive market and a very, very negative market in such a quick period of time after rolling them out. And selfishly, if nothing good comes of any of the volatility that we're seeing, it gave me the opportunity to really test the models out. So when we roll out our Black Crown Alpha, our investment strategy, we know that the metrics that we're tracking and the algorithms that we're using are actually going to work in good times and in bad times. So that's turning a frown, I guess, upside down. And hey, if you haven't already gone, this show is proudly brought to you by the team over at Fridays. You can go to www.joinfridays.com, enter code HIGHER, get $100 off your first order. Everything from GLP-1s, NAD+, longevity, health, fitness, it all ties together. And we are big proponents of the show. Regil is on a GLP-1. I microdose a GLP-1 as well as taking NAD+. Again, that's joinfridays.com, enter code HIGHER. We appreciate the support. Let's get into the market with no further ado. The status of the market is still a capital fleeting risk off market. I really like the way that this model performed in the last couple of weeks. I thought that this was very strongly representative of what we're seeing in the markets. And again, one of the things we do on the show is we try to use the actual ETFs as opposed to the indices. So instead of using the VIX, for example, on a fear gauge, we use something called the VIXY or the VIXY, which is basically an ETF that tracks the VIX. Similarly to all the major indices, the Dow, the S&P, the NASDAQ, the Russell, and the QQQ, we track the ETFs that go along with these here, okay? So instead of tracking the Dow, we track the DIA. Instead of tracking the S&P 500, we track the SPY, and so on and so forth. And these are the way that we tell how the market is moving. There are people who will always argue that these things are including derivative trading, actual cash flows, and the idea is, yes, we prefer that in our analytics for reasons that are selfish as they may be. We just like it that way. But this doesn't get halted by the trading. There isn't any market indices delays that can happen from time to time, and there are some reasons from a risk perspective that we like this more. This will always be your tone of the day. We are in a defensive risk-off position, despite the fact that you are starting to see a bit of a comeback in the markets today. We started off very negative, and we're starting to see a bit of a tech-led pull back in the opposite direction. We are not in a tech-led or mixed rally. We are still capital fleeting, risk off. This is about as close to liquidation as you get. If we get bad market news, you're going to see the ultimate bad situation where people are just going to start liquidating and pulling out because they feel that we're at a market high. I don't know that we're going to get there. And this is probably a good part of the show to start early with the rhetoric here. Unfortunately, the zeitgeist that we're living in is one where politics and economics all impact and collide one together. And there's really no way to talk about one and divorcing yourself from the other one. You kind of have to talk about mommy if you're going to talk about daddy. So because of that, this is going to be a little bit more politically driven show because the big low-hanging obvious fruit is that the midterm elections are coming up. And you got the Republicans who control the House, the Senate, and the White House. And because of that, they're going to want to control and keep power. Not to say that was different from any other time, but there's more of a control aspect to not losing that unilateral control. So there's going to be a very, very heavy focus on the narrative leading up to the midterm elections. And I think that may influence some of the decisions that we're seeing, which do have fiscal impacts. This is not a partisan show. We don't support one side or the other. We try to give you as much data as raw as we can and let you interpret. And there should not be a political swing here. If you come at me in the DMs talking about political allegiances one way or the other, I'm probably going to point to you to some data and say, hey, if that's your opinion, you're entitled to it. That being said, let's take a look at our Synthetic Volatility Index. I have reworked this and I've tried to make this as simple as possible to where it still tracks relatively close to the VIX, but has a little bit more tangible benefit here. Cross-market volatility is still the healthiest thing here, pulling stuff up. The intraday stress and the realized volatility are still picking up normally. If you don't know what those mean, I'm going to publish a model kind of a dictionary, if you will, and an explanation that's going to come on our new website whenever I get an opportunity to do that. But I haven't gotten there yet. And the reason why is I'm trying to perfect this before I put the analytics out there. And whenever I do put the analytics out there, I want you guys to be able to pick it apart. And I'm sure there are people who are going to be huge quants who are going to be like, Chris, this is absolutely stupid. Those are the people I want to hear from. I like being called stupid. I'm that kind of guy. But for those of you who want a proxy, here is the VIX today. VIX is at 2755. That is a huge leap from just 19 a couple days ago, even though it's only 8 points. That's a huge swing on the VIX. And to give you guys an idea of what that looks like relative to other periods of time, this is the 1-year chart of the VIX. 27 is the second highest it has been in the last year. The number one highest was about April 4th, 2025, and we were around 52-ish. I think the highest was 57. So there you go. So we're still about half of what I would say a normalized high is, but we are truly one really grim headline away from being at that number or higher, frankly. And I know it's going to be scary to many, but for the purposes of our modeling, the market seems to be trading relatively normally. And I'm actually going to take a screenshot here, which I don't normally share with you guys, but I'm trying to continue to perpetuate and improve the model. So I like doing this during the show to take snapshots to figure out how I can improve upon it. And shout out to you, Samson. You coming and watching the show whilst on a plane to New York City. Man, that's love. I appreciate that. Let's check the comments. Of course, this would not be a higher standard show if we did not ask for an honest 5-star review. Samson's out here doing the Lord's work for us on our behalf. 5-star reviews are your best way of paying it forward. Hey, we can't all afford to go to Fridays. We can't all afford GLP-1s, and we're not all interested in it. But you know what? We all have a vested interest in helping one another out. It's humanity. Thank you for that. While I go over to Instagram real quick. Yo, what up? Leafs on SVX, bro. Yeah, SV. The markets have been wild, man, and synthetic the VIX has been crazy, and I'm telling you, it's been kind of a nutty time. Let's do a little bit more of a focus real quick on the markets today. I want to show you guys something. I always like to use CNBC for the markets because I know it's something that we can all access, and it helps show you guys where we look, so you guys can look there too. So this is the Dow Jones Industrial Average. We are still down 450 points in the day, but if you saw the futures market last night, this was down a whole hell of a lot more. This is actually a bit of a recovery. Okay, so if we look at the one-day chart here, click the top left there, you can see the market started up with a bit of a dive down and then spiked back up. And now here we are trading what I would call normalized intraday trading. It is approaching session highs, but I don't expect to get there unless something changes dramatically in the headlines, which every single day in a wartime set of circumstances is an opportunity for headline risk. So you have to kind of keep that in mind whenever you look at this. Over the course of the last 5 days, however, this has been a very ugly, bumpy ride. You can see it starting here and dipping all the way down that way. That is not what I would call a not scary picture. Double negative, double entendre. There you go. So it's a pretty scary look at the Dow Jones. Now, I would be remiss if I did not say these are still near all-time high numbers. We are coming off of a pretty crazy run, and you need to look no further than a wider perspective in order to see that. This is the last 5 years of the Dow, right? I mean, that's a pretty healthy line. And this is what we always say when perspective really matters. If you're looking at an investment for a near term, well, guess what? There's a lot of volatility near term in investing. But over the long term, there's generally a good trend you can spot. And you can see it coming from a mile away unless something comes up that you're not expecting. Right now, here's a cold, harsh fact that most people don't like to hear. We were brought up with the American dream: life, liberty, pursuit of happiness. Pursuit of happiness originally was interpreted to mean ownership of property, owning a home, owning a piece of land. You could farm off, you could do all these things off of it. That was the American dream. And for a long time, the single greatest source of most Americans' net worth came from the equity appreciation over time. Despite the fact that your home should be purchased for utility, it wound up being the single largest investment for most Americans. However, over the course of the last 10 years, there's been a bit of a departure in that the S&P 500, and frankly stocks in general, have significantly, by multiples, outperformed the average home price, even with all-time home appreciation in a narrow term period of time. So what does this say? This means that more Americans who have their net worth tied to stocks are getting wealthier and wealthier over time than those who have home ownership right there. But that creates a K-shaped economy even more than most people realize. K-shaped economy, basically you have the upper class, and the bottom is you have everyone else, right? And because you have everyone else, there's the problem. Most people in America were deriving their net worth from the property, except this class here derives most of their net worth from the ownership in companies and stock. And because it has had an outsized benefit over home value appreciation over time, this portion of the economy has gotten wealthier and wealthier, while this one has only gotten moderately so. See, the problem here is not one of Americans aren't making more money over time. They are. The problem is that money that we're making and that net worth that we're increasing is insufficient to keep up with the cost of living around us. Everything is costing more. Some of that is inflation, some of that is technology, some of that is just our expectations. A home today, central AC, a lot of, basically it's a giant computer in some aspects, has a lot more to offer than a home did, several years ago. But these are cultural problems that we're going to have to address. And if the market is telling us this, then maybe there is something to be said for the narrative that we see from a younger demographic who is discouraged with their inability to buy homes in what is the most unaffordable home market of all time. I said it. Maybe there's something to that truth. And the truth is that the stock market's going to pay them more over time if they are disciplined enough to invest. Let's take a look at home affordability, shall we? All right, here you go. Home affordability still remains to be stretched. We have seen some modest improvement. This is largely due to the rate changes. I continue to push the narrative to piss a lot of people off that the supply issue is mostly headline. So there's two things that I think are really misunderstood headline risk. And oh boy, I'm about to piss some people off. Okay. Number one, the mortgage lockout. The mortgage lockout effect to me is mostly marketing hype. Okay. Yes, I understand the interpretation, but if you understand the behavioral economics behind how and why people refinance, I don't see a whole lot of reason why people aren't refinancing at this particular juncture in time at the cadence they otherwise would be, except for the fact that homes are unaffordable. And you could argue supply, demand, one feeds the other. I get all the narrative. All I'm telling you is number one, the mortgage lockout effect is not as impactful as we think. It's the price of the home. And number two, supply numbers and what we need for supply. You've all seen the articles, okay? You need this many millions of homes. We're this many millions of homes short. Well, that is all murky gray area fodder, okay? We don't really know. There are some reports that say we're short 1,000,005 homes. There's some reports that say we're short 4 million homes. There's some reports that say with the Asian demographic and the future movement of where we're going now that we might not be short homes at all. And that's a very narrow view. But look, I believe we're short homes. I believe we do have a supply issue. Do I believe that supply is the biggest constraint on affordability? No, I do not. And that's going to piss off a whole lot of people who say, well, really, the supply is a function of how price, whatever, bro. I don't care. Homes are too expensive. Home values need to come down. That's it. Bottom line. And the home affordability here that we see on this chart is indicative of that. You see the supply constraint is balanced, is the indicative that we have here. This pulling data from the St. Louis Fed. Price to income ratio, mortgage rate pressure, and mortgage payment burden still elevated. I should say, still in a higher risk position. It's putting us in the strain to stretch category down here if you're looking at the heat map. So yes, you have a continual problem with home affordability that remains to be resolved. Let's go over to the liquidity chart. This is one that I also modified recently. We're still in a tense market liquidity. One of the things I did is I removed some of the backward looking stuff. We had some interesting stuff happen with the banking sector during the contagion period where the banks were flushed with cash and they used a reverse repo line. I've now pulled that out because some of that is just normalized banking and it's only one way to go on that chart, and that's usage versus not usage. And over time, it'll kind of phase out post-contagion period. So I decided to rework this a little bit. We're still in a tense liquidity position, but net liquidity level is a little bit more improved with this model as opposed to what we've been showing historically. And that's because the Fed has been pumping in additional liquidity in the markets, which is why the Fed balance sheet shows flood and bank reserves show flood. You've got supportive treasury account levels, but you still have a net liquidity number of drain. You can't spend more than you make, and that's effectively what the Fed is doing, although I am boiling that down and distilling it down to some pretty narrow stuff. Let's do one of my favorite parts of the show. Let's take a look at the sectors. If you guys watch the show, and you guys know that I like to look at these sectors because of each one of the headline data points here. We could go over the details if you want to, but frankly, I find this more valuable. We're going to look at really 5 individual stocks that make up a certain type of risk in a certain type of sector in the economy using the market status down below. As a reminder, I'll go over to the market status and show you what that looks like. We are in a defensive, hiding in safety, risk off position. You have seen some incremental improvement just since I started talking to you here. And that isn't just here on the chart. That's also happening here in the market where you can see we've now recovered. We're now less than 400 points down on the day. So as these recoveries happen in real time, the data and the charts that I show you do update in real time here, and they also parse through to the sector look here. So you're starting to see this Chiron move throughout the day. And as we're looking at charts, you will notice that this does move while we're talking. So this is all real time. This is all real Fed data. All the stuff you see down here below, real-time Polymarkets prediction data and real-time data straight from the stock market. Same thing you get, or actually maybe even a little better given the delay than CNBC. So let's look at the rate-sensitive demand. This is the home builders. D.R. Horton, Lennar, Pulte Group, Toll Brothers, NVR, all down on the day. I expect this rates are going to increase as the 10-year starts to move. And the logical question is, Chris, hey, where is the 10-year at today? Well, it is trending down at the moment. However, this number crept up a whole lot over the weekend. This was at 407 last week. We're now sitting at 4012, and we're down incrementally at 0.003%. This is going to have the effect of pushing mortgage rates up. Like I said, last week, I don't think you're going to see mortgage rates with a high 5 handle. I think it's going to be the 6% plus handle moving forward. Again, not a bad rate relative to the historical perspective of an 8% average rate, but certainly bad relative to 15 plus years of artificial interest rate deflation. Expect mortgage rates to move up. Now, you're going to see data come out in about a week or so, which is going to say that Home purchases, which are a lagging indicator, and home refinance activity picked up a little bit because let's look at the lifespan of this, right? Most people who are going to buy a home or refinance a home have about a 3 to 4 week lag on when they actually start the transaction and close the transaction. And some of that's changing dynamically. There's actually people who are talking about doing it in just a couple of minutes, and it's wild. But anyway, that's a different conversation for a different day. That being said, this is a lagging reporting data. So that happens, takes about a month. Okay. Then it gets reported, takes about another month, and then it gets updated into some of the St. Louis Fed data, which is usually 3 months behind, at least a quarter. So typically in my mind, it's 6 months, but 3 to 6 months is a lagging indicator of the housing. So you are going to see some bumps in response to that data historically. But right now, this is the right move for the home builders if you're looking to trade them down. Number one, construction starts are slow, permits are slow, and they're offering wild discounts. It's now cheaper to buy a new home than it is to buy an existing home, net of incentives from the major builders. And this rate sensitive environment, we see rates rising. This is behaving like you would expect it to behave. You see the values going down. I will then now switch to the next sector. And if you're like me, you know how much I like talking about the banks. Okay, the banks to me are where I come from. Banks are down big today. Credit conditions in the market, they're continuing to worry a little bit about this. I think you're going to see the major GSIBs, the globally systematic important banks, continue to suffer during this period of time. But asterisk here, I do think you're going to see a lot of M&A activity in the small community regional banks. This is really market volatility and fear driven. You've seen some consumer data come out, which shows some weakness that people are ignoring. There's a lot of fears in the private credit markets, which aren't necessarily going to impact banks, but I think banks are getting taken down by a lot of the narrative here. And it's not, frankly, too crazy to think about that. If you know the consumer's hurting, if you know that joblessness claims are coming up, we just had a massive miss of unemployment. We went back up to 4.4%. And if consumer discretionary spending, which will be one of the consumer charts we hit here in a sector in a little bit, is suffering, it makes sense that the banks will see a transactional slowdown and possibly weakening credit conditions, which could impact them. And this is the market being somewhat early to react to that. And I don't necessarily know that this is a bad call. I do think long term the banks are going to do well because their net interest margin, their primary way of making money, is going to increase. CRE and REITs. Now, again, the market is down as a whole, so you're going to see a lot of red today. This is going to feel a little grim, but believe me, some of these are actually buying opportunities. I believe that the commercial real estate companies, Prologis, Realty Income, American Tower, Simon Properties, Boston Properties, etc., I think these are buy opportunities if, one, they're transitioning from office to data center, which, frankly, you can't avoid where the QQQ and technology is going, and we're just going to need more data, more compute, and more power. So I think the energy and those particular CRE companies, commercial real estate companies that are invested there are going to be huge. I do think as we are in flight to safety, real estate investment trusts are going to be a nice, healthy, safe place for people to go. There is some upside there in the next 6 to 12 months, particularly if we have a prolongated wartime period where we start impacting the economy. We're going to talk a lot about that coming up. Saeed, I see you out there, brother. How you doing? I didn't get a chance to call you. So for those of you who watch the show and you watch the regular Tuesday show, you know that Saeed and I are, well, we're close. We're friends. We're like brothers. But we talk a lot more than you probably realize. Pretty much every day, multiple times a day, usually in the mornings, and usually on my way to work, and usually, whenever we get a chance. So, Saeed's my guy. I did not call him this morning. And for that, I am sorry, my friend. But let's be honest, my guy's still out here. Shout out to everyone supporting the show. We are on the verge of this being the largest scale disruption of the energy systems in history. Frankly, I think we're already there. That's my honest opinion. And I'll explain. The Strait of Hormuz is an important strait, but you've got a lot of the surrounding countries now shutting down production, limiting production, and like housing being a lagging indicator, I think a lot of the lag of this will be felt for quite a long period of time. And I think if you're the government, right, and this is the headline, and it has been the headline, and we're going to talk about that with some of the AI-driven XAI stuff we're talking about usually in the show here, then you have to think about the midterm elections. How much negative press can you have going into midterm elections from a strategic perspective? Number one. Number two, there is something to be said. Wartime presidents do statistically, historically, have a greater probability of being reelected than non-wartime presidents. However, is this a party play to be reelected for the party? Is Trump going to try to deviate from the two-term situation? No one knows. There's been a lot of fodder and a lot of speculation. I'm not here to do that, but I am here to tell you that these things do have a tendency to provide strength to the incumbent party going into elections, both midterm and traditional elections for things like the president. So keep an eye on all of this as it continues to play out. I think I just cut my foot. Wow, that's wild. Anyway, keep an eye on this stuff as it plays out. It's going to continue to evolve, and I think that the political narrative here is going to be a heavy, heavy, heavy impact on the overall status of the market in the days and weeks to come. Shout out to my friends on Instagram. Rosie, temporary pain for long-term gain. That is the hope for sure on what this actually could wind up being. Let's get back into the market status. I think there's some more sectors we should talk about quickly. And we're going to pivot to the X and the AI and Instagram review of the popular trending topics on social media from a finance perspective. Stay tuned. There's some interesting ones on that one. And then we're going to get out to the web and look at some of the narrative to cap the show here today. Let's get into the sectors again. So we just talked about the real estate sector, and you know my thoughts on it, so I will forego the rest of it. Mega caps. This is going to be your Apple, Microsoft, Nvidia, Amazon, and Alphabet. These are mixed today, which despite the fact that the market has been trading the way that it is, this is actually kind of wild. Nvidia is every single day I listen to Nvidia in the headlines, and after 13 consecutive quarters of earnings beat, they trade down. And you're like, what the hell? Okay, maybe people are going, okay, it's overhyped. And then they start saying that they're not going to invest in certain things like Oracle, for example, or back and forth. And there's just all this like inbred, weird economic situation going on. And I'm so kind of tired of seeing like this up and down, and it's amazing, it's not amazing, and that this golden child kind of conversation. It's like, can we talk about the other children for a little bit? Because look, good for you, Jensen. Jensen's a stud. But can we talk about somebody else for a little bit? He's got enough market share to control everything. But the narrative here just drives me nuts. Anyway, so that's that. I'm not going to spend a whole lot of time on it. Consumer is one of my favorites. All right. Walmart, Target, Costco, Home Depot, Dollar General. Costco up. Costco is kind of a workhorse, if you want my honest opinion, long term. But I think the soon-to-be breakout winner may be Target. I said this in the last show. I'll say it again. Walmart really tried to go head-to-head with Amazon. They put out the technological infrastructure, and they really tried to make something of themselves. I think it went really, really well. Target, in a lot of ways, has been mismanaged over the course of the last couple of years, but they do have a new plan. They are selling consumer data as a separate auxiliary source of income and business model. I do expect them to be somebody who has the potential to grow out of this kind of negative streak they've had over the last couple of years. And for those of you who want a visual example of that, we got you. I can do that for you here on the show. My allergies are kicking in, man. All right, so this is Target today, close to at session highs over the 1 day period. Let's look at it over the course of 1 month. Come on, 1 month. Where are you? There you are. All right, 1 month, still positive. Let's look at it over the course of 1 year. Come on, there you go. So yeah, not a bad trajectory. You've had some pretty tough times in and around that space, but certainly it's been rallying back, and we are at a 1 year all-time high right now. So again, it's not just me apparently who believes in this; the market believes in it too. So that's a good sign as far as I'm concerned that I'm not completely full of shit, just slightly full of shit. All right, let's go back to the sectors here. Finish off this so we can get into some of the sexier headline topic stuff. I know you guys really like that. I like it too. Industrials. Caterpillar, Deere, General Electric, Union Pacific, 3M. Surprisingly, the top two are still positive, barely so, but not a whole lot there. Energy sector, well, this is the weird thing about the market, right? As Saeed said, we're looking at an energy crisis. Crude oil prices are going to go up. But this is how markets work. And it's messed up. I'm not going to tell you it's not messed up. It's messed up. Okay? They expect these companies to make more money. It's people going into them because they expect them to make more money because they can charge more money. Prices rarely come back down. They almost always go back up, and these companies get more and more profitable. You get on this hamster wheel. It's part of the reason a lot of companies aren't continuing to go public at the cadence they once were historically. You put yourself on the earnings hamster wheel of having to actually speak to the public every quarter, then beat your earnings and you give analyst expectations and guidance and to do all this stuff. It puts you on this hamster wheel. It's a never-ending hamster wheel. People always want to see you do better, 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 and there's only one place to go. That's failure. You're not going to perpetually in every single market do better. So that's the wild thing. But yet these companies that are public like this have a fiduciary job responsibility to take whatever's happening in the economy and try to make more money off it. So despite the fact that we are looking at a situation where you're going to have significant oil ramifications, energy crisis happening, led by the Strait of Hormuz being closed, all the domestics here, they're all still making money and they look positive. Schlumberger having probably the more exposure to the Middle East than the rest of them, frankly. So yeah, it's a strange thing how our markets work. Let's go to the defensive. Okay, so this is a great example of what we've always talked about here. This is our defensive and yield stocks. These are 5 examples, but there are many more just like it. When the market goes defensive, risk off, or liquidation, or worse, which, believe it or not, can be had, we've always felt that capital preservation, the money will fly from riskier asset classes into things like Procter & Gamble, Coca-Cola, Johnson & Johnson, Nextera Energy, and Duke Energy. Yeah, that's right. That's the safety mechanism. Now, of course, you could say, well, Chris, there are other mechanisms that are hedges against inflation. Wouldn't people go into those? And yeah, they can. But we've had some crazy volatility in things like Bitcoin. Bitcoin's sitting at 68,626, still up from where it was just a couple days ago. But you know, it's certainly had some volatility and went down super low, came back up. But you're looking at this probably coming off of a high again of around $70, where it broke 70,000 shares again, or 70,000 per coin again. So, look, this does not seem. I mean, even though we've seen some resiliency come back, this does not seem like to be. It's got like a straight arc recovery if it's going to recover. And people were arguing that Bitcoin was a hedge against inflation, and I don't know that that's ever really been the case. The only true hedge against inflation is to keep investing. Meanwhile, gold is actually seeing a little bit of a down spike here, but when you look at over the course of the 1 year, it's undeniable that it has had a run up that has been very, very different than many of the people. This is the 1 day, 5 day, and 1 month look at gold. You can kind of see it's relatively flat, but certainly over the course of 6 months and a year, you start to see that same arc start to manifest once again. So certainly seeing the defensives do exactly what we thought they were going to do in times like these. We're starting to see them grow. All right. For those of you who never watched the show before, everything that's pretty much on this side of the screen is going to be my AI web-driven stuff. Everything on this side of the screen is going to be more analytical, data-driven. To that end, we are going to get into the XAI. This is our AI pulling and scraping the Behavioral Economics Forum social media, as you and I all call it, and looking for the top trending items. You're going to see the impact on the market sectors in the mention right here. You're going to see the actual content there. And down here below, you're going to see AI's interpretation as well as a controversy score. Is this a highly contested topic? Is there general consensus on this topic? Where does it fall in the spectrum? And this Chiron down here will help tell you exactly when and where that is. And we have some basic data on this in the back end. Don't worry about that for now. Let's just go over what is important in the market today. And obviously, like we talked about at the top of the show, oil price volatility and Trump action is top of mind on the social sphere. Oil prices experienced extreme volatility, initially surging 30%, then rapidly reversing just 2 to 4% gains as Trump announced intervention plans and a 5:30 p.m. news conference. Multiple intervention options came of that. So they've talked about backstopping this with insurance. They've talked about using the U.S. Navy. They've talked about doing all these things. None of these things are going to change the volatility in the markets, okay? These are all things that we're trying to do to calm the waters of the fact that we are actually there doing something. And until that something is done and there's been a transition away from that, I don't know that you're going to see stability, okay? Let's take out what AI's inputs here. The 26-point oil reversal in 13 hours suggests massive algorithmic unwinding. Watch for overshooting to the downside, creating energy stock buying opportunities. There you go. AI turning a frown upside down. There you go. Of course, number 2 topic is the Iran-Israel war escalation. Israeli officials expressing growing concern about escalating conflict with Iran, discussing potential exit ramps and endgames. U.S. war with Iran has triggered historic oil supply disruption, according to... Okay, this bothers me a great deal. And I'm going to pause before going on. There's some G7 commentary here, some NASDAQ recovery, and some natural gas conversations to have, because that's also in a bit of a collapse. Talk of exit ramps from Israel officials suggests de-escalation position could signal peak geopolitical premium in oil defensive stocks. Okay, I'm gonna be the asshole here, okay? And I know inevitably I'm gonna get people who are all up in my business about this, but I'm gonna do the thing, okay? I warned people very clearly not to celebrate the falling of the Ayatollah in Iran, because regime change was not liberation. And yes, he's a terrible person, and no, I don't support him or think that it was a good idea that he stay in power. However, there are a lot of people just like him in power in the regime, and it is not this unilateral monarchy, although ironically his son was just named the next supreme leader, which does beg the question, is it acting more like a monarchy now than a religious regime because you just named his successor as his son, which I'm sure they had some internal conflict over because it just looks bad. But that being said, there's a whole narrative here that we have to face. And I'm going to try to do this with as little political fodder as possible. But I posted something yesterday, which I think is important to share. I'm going to see if I can show this on the AI view here, the social view here. Here's the social view. Perfect. All right. If the goal is to liberate Iran, airstrikes will not be enough. I'll explain that in a moment. Liberation requires boots on the ground. With Murtaza Khomeini expected to extend hardline rule, because he's just like his father, a cleric, markets should brace for wartime volatility, rising recession risk, and the real possibility of near-term bear markets. With midterms looming, domestic politics alone may ultimately shape how long this lasts. Okay, if the U.S. went in there to liberate the people, that ain't going to happen without boots on the ground. Okay, not my opinion. This was originally reported on by the Washington Post, and then I would do something very simple. Went right over to ChatGPT and I asked a very simple question. There was no previous prompt. This was it. This is the only thing I prompted. I said, "Hey, can people be liberated in airstrikes only?" That's about as basic as you can ask a question. No context. That was the question. The answer, a short answer here, and there was a much longer version of this, but I just cut up the first piece to show you here. Almost never. Air power alone has historically been insufficient to liberate a people or produce stable political change on the ground. If we did not do this to produce stable political change on the ground, and we did not do this to liberate the people, and we abandon it, what have we done? I'll tell you what we've done. You've taken a religious leader in the middle of a religious period or holiday for them, Ramadan, the holy month. You killed him, made him a martyr, and took whatever, I guess, disintermediated people or people that were literally maybe on the fence or separated and brought them together religiously to make the regime ultimately more powerful, not less powerful, because now there's a sentiment of we hate the West because not only do we not like them before, but now they bombed our country, left it in ruins, and we still have the same political regime that we once had, just a different leader there. And this, oh, by the way, is the guy's son. So I'm not claiming a political side one way or the other. I'm just saying, like, I don't get it. And I don't know, with the midterms coming up, that the U.S. can, from its own home political strategy, continue down this path without risking the, this question coming up from a broader political perspective. But now you got Israel saying, "Hey, we're gonna back it up." It's like, okay, well, what was the point, guys? Did you guys get into this with the idea to take the region over? Because that ain't going to happen, at least not yet anyway. Did you guys get over this with the idea to liberate the Iranian people from oppression? A noble cause, good for you, but did you do it? No, you didn't do it. Okay, well then you did it to just kill the guy then, because the regime is frankly the same with his son leading it. So I'm trying to figure out where this goes and why, not because I give a damn about the politics, but because I care about a people and a population, and I do care about the economic impact to all of us. That's our show's purpose. Now, I should put an asterisk here. There is still Palestine, there's still Israel, there's still Ukraine, there's still Russia, and there's many, many examples all over the world happening at all times. This is the most visible one because it's the most recent in time. And I will be honest, this is the most financially currently impactful one to the United States, which is why we cover it on the show. I generally try to avoid all of these topics. So I think I've done enough disclaimer there to try to at least ward off some of the hatred that I'm inevitably going to get because I talk about these topics. But I think this is an important one because I think that there is going to be some pretty crazy changes coming down the pipeline as it relates to this in particular. And I think you're going to see it more and more in the headlines. I do want to get back into this, but this is what I was talking about earlier today when I was talking about the Dow futures. This is from last night. 800 points was it? The Dow the futures were down about 800 points. It went down about 1,000 points shortly after this. Oil spiked above 100, went up to $120 per crude oil following supply disruption of the U.S. and Iran conflict. Energy shocks like this threaten to slow the entire economy by pushing inflation and costs higher. If oil stays above $100, then the 10-year is more likely to move. Okay, so let me preface this. Okay. This is the Monte Carlo analysis. There's two options of the way this could play out. This confused some people, and I didn't mean to do that. If oil stays above $100 a barrel, okay, which it's close to now, the 10-year likely moves higher. Inflation expectations creep up, okay? And you are seeing some of that, and I think, in the market volatility. If equities panic, the stock market, and money runs to safety, the 10-year could drop quickly on a flight to treasuries, meaning people are going to go into the 10-year treasuries, market's going to come down. Well, guess what? Then you might be able to get better mortgage rates in that scenario, assuming the Fed actually injects here. Now, historically speaking, again, using the history here as our guide, the Fed generally does not make moves during wartime sessions. And I should also point out that the transition from one Fed chair to the next Fed chair doesn't happen until May. And well, while there's some rhetoric that we could be in this war till at least September, there will not likely be a change until, at least in the Fed funds rate, until at least June is my best guess based on the data right now. But don't take my word for it. We are looking at the Fed tool, Fed Now watch tool. This tells us there's a 97.3% probability of holding rates exactly where they are. And this tiny little nugget right there, the 2.7%, is your probability of a rate cut. So again, the market doesn't believe that's going to happen anytime soon. So I think you're going to see whatever inflationary pressures you see in the market driven largely by oil and not by Fed policy, which frankly is probably the best way to handle it, and why the Fed generally does not make these moves during wartime initiatives, because the Fed is data dependent. There is more here to break down in the XAI sphere. G7 oil reserve release. G7 nations discussing coordinated strategic oil reserve releases to stabilize markets. Energy ministers meeting on Tuesday morning tomorrow to discuss reserve deployment options. Coordinated G7 release reserves historically provide about 2 to 4 weeks of price relief. Okay? That's an important thing. 2 to 4 weeks of price relief. Look for energy sector rotation opportunities as supply concerns ease temporarily. Okay. Now is a part of the show where we have the political conversation that is financial that actually pisses people off. So perk up, get in your situation, get seated in your situation. Let's talk about this. And look, I'm going to be honest with you. This is going to be uncomfortable. Okay. So let's do this. We know some things are going to happen here. I'm giving you the side eye because I want to be serious. All right. Number one, Israel is already vocally saying publicly that they want an off-ramp, an exit strategy. Number two, the midterm elections are in fact coming up and are meaningful. Number three, you have seen palpable, visible volatility in the markets. On the Monday of last week, when you should have had it, you didn't see it. On Tuesday, you saw a little bit, and then Wednesday, wham! You started seeing volatility. You're now seeing over the weekends. You got the Dow futures trading down, oil prices spiking up. I'm not a big believer in trading off the futures market, but I do think the futures market is indicative of volatility. You're seeing the VIX at 27. You're seeing our synthetic volatility continue to show signs of weakness relative to where it was. It was 30 points higher just a couple weeks ago. So you are starting to see some pretty strong indicators. Now, everything we've been doing fiscally up until this point has been trying to hold off a recession and to improve the overall economy from what was 9.1% inflation to stabilized inflation. The Fed has two mandates: job stability and price stability. And yes, I'm watering it down, but jobs inflation just went the other way after a massive miss. And if you've been watching me for any period of time, you know that I think the jobs numbers are bullshit. Okay, go to seekingalpha.com, type in unemployment numbers. You're going to see a lot of good articles, really meticulously done, about why those numbers have been just materially wrong. Some of it's the way they report, some of it's just some stuff that they do. But most importantly is the revisions never get headline coverage. A lot of these jobs will come out and they'll be revised down. Last year, 1 million jobs vanished from the jobs numbers because they were revised out over quarter after quarter after quarter. And by the end of the year, 1 million jobs we were told were there weren't actually there. In this particular instance, we thought we were going to get a 55,000 job positive number, and you got a 92,000 job negative number, okay? From a lot of the same sectors that just a month before, like services and healthcare, they said were booming. So, bullshit. Now, you got a Fed who's looking at this stuff going, okay, well, what are we going to do? Are we going to cut rates? Are we going to increase rates? All this volatility is going on. And as you know, the Fed is data dependent, and the data is all over the place. And now you got factors like this that are impacting the economy. Well, the Fed historically does not make these moves like we just talked about during wartime initiatives. So they're going to pause a great deal, which means whatever happens next is not going to be because the Fed, you can't point the finger at them. You can say, hey, you just didn't fix this, Fed. But the question is who created it at this particular time. And that's going to be a lot of finger pointing at political parties. Now, you know, G7 is going to meet. They're going to release some oil reserves, and the government, as our government, is going to find a way to try to backstop Lloyd's of London pulling out of the insurance market, use the U.S. Navy to help ships through. 80+% of that oil goes to Asian markets, and China probably being the number one buyer here. We have Venezuela, Trump now threatening Cuba. We've got some very weird shit going on. That's the only way to call it, okay? But if you got 2 to 4 weeks of price stability built into what the G7 is going to do, I think you got to get out of this war in the next 2 to 4 weeks if you're going to get out of it and not go boots on the ground. If you are going to go boots on the ground and you are going into there's also an ego play here. Can the White House be seen to get into a war, say they were going to have regime change and not actually effectuate regime change, and now have a population of people pissed off and in control or let down emotionally? I mean, there's a lot of behavioral pieces to this that are just human sociological behaviors, human psychological behaviors that I think you risk by pulling out too early. If you go boots on the ground, Iran is 3.5 times the size of Iraq. It's a very different strategic and tactical point. Yeah, the Kurds may help you out, but you still got a whole lot of other challenges out there that are going, frankly, unaddressed. So I think if you're going to get out, if you're the U.S. and Israel, you think you're going to get out, the next 2 to 4 weeks are when you get out, okay? Because you got the strategic oil reserve, you find a narrative, you go along that narrative, you get out as quickly as you can. But doing that risks a whole hell of a lot more. If you're going to go boots on the ground, you tell people we're going boots on the ground, you say you're going to be in it until September, and you say, okay, wartime presidents have a higher probability of being reelected, and maybe that's the political slant during the midterms. Hey, don't change the decision-making vehicles that we have now in the House and the Senate and in the White House, because you know what? These are the things that are getting the job done here, and we got your back. We're the people, or whatever the narrative might be. So there's going to be a lot of tumultuous volatility in between now and, frankly, until all of this settles down. And I don't see any of it settling down in the next 2 to 4 weeks at the very least. And certainly the narratives and the geopolitical conflict are going to continue to peak up. So all of this to say, not that I'm ranting, but to be thoughtful and pragmatic about the stuff that you're hearing. Some of this is going to get more wild before it calms down. And I think if you're a dollar cost averaging investor, just keep investing. Just keep doing. If you put $500 away every single day or every single month into your, Fidelity or your Robinhood or your E-Trade account, and you invest that in the ETFs, do that. That's fine. There's nothing wrong with that. Over the course of history, that investment's going to be totally fine. If you're somebody who day trades and likes a lot of volatility, well, then guess what? You're going to get a lot of volatility, but you're taking on a lot of risk and things that are unknown. If you're somebody who trades in the poly markets world, do your research, man. There's a lot of insider trading. If you see momentum, be thoughtful, be pragmatic. But this is not the time to stop buying. Okay? This is the time to think about what you're buying. And this is the time to think about the things that you do. And I know that that's going to make people go, wait, what? What about home prices? Well, home prices historically over the last 10, 15 years have not returned the same amount of returns the S&P has. You've been watching our show. You know, we've had strong feelings about the 60-40 equities bond split that was such a popular thing for such a prolonged period of time. Matter of fact, we recommended 80-20. 80-20 being the NASDAQ and crypto, specifically Bitcoin, possibly being the best possible investment. And I know someone's watching this going, what? No, we're just offering different opportunities. If you don't believe in the 60-40 save money over time, live a long life, you'll be rewarded at the end. And frankly, there's a lot of people who feel that this was a lie to them, that if you save, you'll be taken care of. They don't feel that way anymore. Then this might be your new investment strategy. You go 80% into the NASDAQ, 20% into the QQQ. I'm sorry. 80% into the QQQ, the top 100 performing stocks in the NASDAQ, a very tech-focused space. 20% into Bitcoin, not via an ETF, not via a third party. You hold Bitcoin yourself directly. And if you can't own a single coin with that split, then buy a fraction of a coin and continue to buy until you buy more and more over time. And now I'm sure some crypto pundits would say that's a big, if you don't believe in crypto, you don't believe in Bitcoin, fine, then you still have to have a pretty significant exposure to the QQQ, because here's the problem. The world as we know it is energy, tech, and compute focused today. It's part of the reason when we go to the market status that you see a separate carve out for tech leading the way. Tech is the way of our future. You cannot divorce yourself from the fact that this is leading the market and this is the new technology. We are not in the world of assembly line 1920s growing this up in the Industrial Revolution anymore. This is our new industrial revolution. You need to be focused on tech. Every company will have exposure to tech. Every company will have some type of leverage vehicle there. And compute and power, whether you believe in AI or you believe in crypto or not, will continue to be a fundamental portion of growth in people's portfolios and their respective companies. Okay? I'm off my high horse. I hope that at least gets something done there. Yo, what up, Instagram? What up, comments? Rosie, this war was an egotistical move. Iran is a religious state, unlike Venezuela and Cuba. Well, yeah, I don't think you can compare it at all to Venezuela or Cuba for that matter. Venezuela was a small victory lap, and I think they're eyeing Cuba as possibly another quick victory lap, which may be a distraction from the Iran side of the war. Venezuela, you went in, you got Maduro, you pulled him out. People were celebrating in the streets, but there was not a backstop. There was a vice president who was very much in line, but we haven't heard anything there. And I don't think the people were as felt as repressed. And maybe there's somebody here from Venezuela who can tell me what the public sentiment is. I don't know it well enough. I am half Iranian, so whenever I hear about the Iranian community, I have a lot more connection to that particular community. But certainly there's some strange things happening, and the U.S.'s involvement here to me is very, very, very strange. U.S.'s involvement was very different in Ukraine and Russia, which is still ongoing, mind you. The U.S.'s involvement in Israel, in Palestine, was very, very different, at least publicly anyway, and that is still going on, mind you. So I don't know how we could declare this over if we were in Iran or those levers. A lot of this doesn't make sense, and I think that the lack of disclosure to the people on how some of these decisions were made are discouraging. And I know people say, okay, well, nuclear weapons, fine, okay, that's what it is. We said the same thing about Iraq and weapons of mass destruction that were never found. So not to say that I don't trust the government, just to say that I just feel like an additional disclosure is an important part of that conversation. And I'm going to ask one pointed question, which I'm sure is going to ruffle some feathers. Iran has been very bold about showing pictures of like their drone fleet, about showing pictures of things that they're doing. And there's been a lot of disinformation on the internet from everybody, from them, from us, from third-party countries, everybody in between. Who knows what you trust? Why haven't we seen a picture of an Iranian nuclear weapons manufacturing plant or an Iranian nuclear weapon? Why haven't we seen any evidence of that yet? And not even from the disinformation campaigns, which is kind of nutty. I've seen guys riding carpet shooting assault rifles that has made the rounds on the internet as comedy, but we haven't seen anything from their state, which seems to suggest that was something that they actually had. And maybe the conversation was they were targeting other targets and maybe there's other stuff there. But again, when do we as a people get access to that information so that we don't feel the worst thing you can do to humanity is to let them speculate, right? Look what happened in the alien UFO space. You leave humans to speculate, and we do. We're all over the world, like guessing at what could happen. I think you got to take some pressure off, and whether people believe you or not, it's a different thing. Let's go, Saeed. What you got going on in the comments? I haven't been looking at the comments a whole lot. I apologize. I've been on my high horse a little bit here. What do we got? Let's check the comments. Miss Powell Dwyer. That guy died. He was such a stud. BFFs. Shout out to everyone supporting the show from Saeed. There you go. BFFs. I don't even know what that is. Currently perked up. Did I miss the whole conversation with you in the comments, Saeed? Or are you just talking to yourself, man? What are you doing out there, bro? Let's go over to X real quick. Let's check some of the headlines. It's been about 53 minutes, and I am cognizant of time. I want to see what's popular rhetoric in the sphere here on X. So let me clear out Saeed's chatting amongst himself group talk here. And if anybody has anything they want to talk about or they want to get into, now is the time. But let's get into the X layout, do the social view here. All right, Microsoft just partnered with Anthropic to launch an AI that could run office work for you and replace millions of office jobs called Copilot Cowork. So I'm assuming that's using Anthropic's Cowork with Copilot, which was dog shit. Copilot from Microsoft, at least good for you guys in recognizing how terrible your product was. You describe the outcome you want. The system converts it into a step-by-step execution plan. It pulls information. Interesting. From your emails, meetings, files, the chat, then executes tasks across Outlook, Teams, Excel, and PowerPoint. It can build meeting decks, research companies, and preparing reports. Wow. It can reorganize calendars and schedule meetings automatically. Yeah, Anthropic Cowork is a pretty powerful tool. I haven't used it enough to opine, but look, man, some of these office skills are going to be really changed. Now, there's an interesting article that came out as a research piece that I haven't read the entire thing, basically suggesting that AI is incapable of not, quote, hallucinating. Meaning that these errors that we see from AI, and a great example of this, a classic example of this, is an attorney asked AI to put together a legal brief and cite respective cases that are on point and applicable, and it will literally make up cases, make up facts, and put it in there. And then you read the whole thing. It sounds sincere, has a case citation. You read it. If you don't watch closely and you don't know that's not an actual case, you could submit that. And that actually has happened in courts. And they call those AI hallucinations. We've all used AI, and AI has given us wrong information. They call those hallucinations. The article's premise was that that is an impossible thing to eliminate entirely from the system, and it went over a whole litany of reasons as to why and how that works functionally. I think it's not as grim as people are making it out to be. I think tantamount to humans, you can't get 100% honesty and truth in humans. Sometimes it's embarrassment, sometimes it's manipulation, sometimes it's just convenience, and sometimes it's just false narratives. But that being said, I don't know that that is necessarily a terrible thing, as much as it's something that you just got to be aware of. Moving on, the build your own cybercab fleet, 0 to 300 vehicles in 36 months. Have 6,000 saved up. You can purchase a cybercab and plow all the tax flow. So this is actually interesting, and I've seen several different analyses on these as the cybercabs roll out from Tesla. To me, these things can make you about $30,000 a year per cybercab. You build a fleet of 10, you make 300. You build a fleet of 20, you make 600, and so on and so forth. I think it's an interesting model and use case, and I'm really curious to see how that rolls out and who makes money on it. There's a guy not too far from me who owns an entire fleet of Tesla Model 3s and Model Ys that he uses, and he basically pays drivers pay him to use his vehicles, and then instead of using their own, and then they drive around as Ubers, and he makes a pretty good profit. At least it looks like that from the outside of the building anyway. And then he houses them all there at night in storage, and then does all the work there. And they work basically 24/7 in that building. It's becoming an interesting model when you think about the context of it. What would be really curious to me is if you have a cyber cab fleet, and like most Teslas, they don't require a whole lot of work. You can really run that with a small service team, AI logistics, AI like responsiveness in the front end from a customer service perspective, and then one person kind of overseeing everything. You could really reduce your human FTE full-time employment costs in order to run that model there. Dexter is an autonomous financial researcher that lives in your terminal, thinks, plans, analyzes real-time market data, and self-improvises as it works. 17K GitHub stars, compatible with Claude, Codex, OpenClaw, an AI hedge fund and analyst that gets better every time it runs. So I've seen a lot of these articles lately on poly market prediction models, on models like this that call themselves hedge funds analytics. And I'm actually impressed by some of the things they can do. I would caution there's a lot of hyperbole as to what these things can make you financially if you go down this path. So I would just say urge caution here, be thoughtful. But yes, we are getting to the point where some of these models like Claude skills can be downloaded, and you can actually start to trade in the stock market based on what these models do. Now, that this is not a substitution for you understanding core fundamentals, things like price, market cap, PEs, and ratios, and things that are very important. But certainly, these are becoming much more accessible to the general public. And I think as VPSs roll out, and we're going to get to the point now where Claude and OpenAI ultimately roll out their own like VPS personal computer for every single person, as opposed to just using Claude or the LLM. You're going to have your own basic computer that remembers everything that you said and done to it, and then whammy, you're off and running, and everybody has their own agentic AI agent, which I think is probably where the future of this goes. But for now, we're all using Mac Minis or a VPS. Okay, friends, family, questions, give it to me. Hit me with them. Let's go. I could go down this path forever and ever on the website. We've kind of hit the market hard today, and I've given you guys the full look at what I think is going on there, and I don't want to beat it up. But for those of you who do comment, I want you to know that I do appreciate it. I don't bring up this view a whole lot, but these comments are going on in real time throughout the show, and I spend a whole lot of time on my interface looking at them and reading through them. I don't bring them up on the show just because I think it takes away from what should be a more buttoned up look, but I'm not trying to be as polished as CNBC when we do this, but I am trying to give you guys at least as much data as possible in a short period of time. So it means a whole lot to me that you guys support people like Rosie, people like Vic, people like Samson, everybody who comes out here, even Saeed, all these people who Saeed co-hosts the show, And, Shane, a lot of people who are on the show and watch us regularly. I know this is a tough time of day. You can always see it on X. You can always see it on LinkedIn. I do move it to off visibility for the algorithm performance on YouTube. I hope to change that one day, but until YouTube changes their algorithm, that's unfortunately the best way for us to do that, just to try to bolster that channel. Our audio streams on the podcast are sensational, but the video ones on YouTube have never been anywhere near as good as they are on the audio streams. That being said, I got nothing else for you guys today, kids. That's about it. It's been a wild start to the week. Hopefully, we see the week stabilize. It's usually what happens is the weekends, you get a lot of crazy headlines. Unless something material happens during the trading day or during after hours trading, the rest of the week will kind of rationalize and normalize, and then you start to get a little more hysteria throughout the rest of the week. Here we go. Love your content. Thanks, man. I appreciate this. Who is this here? Roger, I love your content. For someone trying to get as sharp as you at finance, what should I study the first, and what should I be watching every single day? Okay, well, I'm not that smart. I'm actually a moron, but I spend a lot of time being a moron looking at stuff. Believe it or not, you can learn a little bit through osmosis by watching CNBC. When I started in this business, one of the first things when I got to a big boy job was I requested a TV in my office so I could watch CNBC all day long, so I could watch the treasuries. And I knew that 10-year went up, treasuries move. If you want basic fundamentals, Rich Dad, Poor Dad is still a great one. Multiple Streams of Income by Robert G. Allen, as cliche as it sounds, is actually a really good one. I think it's going to be more and more important in the age of AI and technology. But there's a lot of great books. Really listen to our podcast on Tuesday. Said and I spend the time to really think about these and talk about them colloquially. That conversation is supposed to be more like a sitting down with your friends and family and having a conversation over a couple drinks or cocktails or whatever it might be. In our case, energy drinks. And really trying to understand the narrative of things that are happening in the economy. And we do that to try to destigmatize the idea of some of these terms and ask questions. We're here to help you. We do have a THS, the Higher Standard Education platform that we are rolling out. When I talk to this screen over here, that one, it's actually a teleprompter right there. And that teleprompter is going to be used for Said and I to make educational content at the desk, where we can go over single topics in bite-sized chunks, think 18 to 13 minutes, and then disseminate that in just a purely educational piece. We've been delaying on doing it just because I've been focusing on the models and some agentic AI stuff that have come out, and there's just not a lot of time in the day. I do have other jobs and other companies that I run, but certainly we'll give you some of that too. And then ask us questions. You can hit us at media@higherstandardpodcast.com. Literally any question you want, and we'll get back to you. Not always the fastest, but we'll get back to you. And there's a number of other YouTube channels that we can recommend. Caleb Hammer, believe it or not, if you like the stigma in his channel, does teach some valuable lessons. As much as I hate Dave Ramsey for a number of reasons and some of his advice. Some of his advice is meaningful and good, and there's a great channel there as well. I think the world has shifted away from some of these books and shifted more towards learning through watching. And I know that ironically education doesn't work that way for everybody, but that's probably the best way to do it. But yeah, you learn a lot throughout the day of just watching CNBC, then just Googling things that you may want to understand a little more about that catches your eye. Find things that you're interested in. Find a sector you like a lot and spend some time doing it. I was an executive at a publicly traded company for a prolonged period of time. So a lot of the SEC stuff, a lot of the reporting, a lot of the ratios just became an important part of my job every single day. And honestly, I was always concerned that I didn't know enough. Even today, I'm still concerned that I don't know enough. And I think no one really knows as much as you think they do. A lot of these talking heads, and I'll use myself as an example, I know the banking space really well. Was in it, did their earnings calls. And I can tell you a lot of these talking heads during times of turmoil, like the contagion period back in 2022, had no clue what they were talking about. They sound like it. They look very confident. They're very buttoned up and polished, and they have these debates. And you just look at some of them sometimes and you go, like, you have absolutely no clue what you're talking about. And there are other people on the other side of things that know the ratios. I think private equity, they come into companies, they know the ratios, they know the balance sheet, they know the income statement, they know how the companies are supposed to operate from a collegial perspective, but they've never actually been a physical operator and know how humans work and engage with that kind of conversation, which is why you get those personality types that seem to be heartless around humans, for example. So lots there, but send us an email, connect with me, I'll help you out. And then obviously you can catch us on social media as well, and you can DM me on all those. I do respond to as many people as I can, which is usually everybody, because I don't really have a lot of followers. So got a lot of friends. Love you guys. Appreciate it. We'll catch you on the next show, Wednesday, 11 a.m. PST. Hopefully by that time, this market has calmed down a whole lot since we started off kind of rough. Bye, everybody.